I want to move on to a paper that I enjoyed reading all your papers, but this one, man, it's so cool. Uh, to start off with that one, can you talk about how does the index funds demand for securities differ from that of other investors?
Right. So index funds are really special in the sense that, like, if you give a dollar to SPY, they don't get to go like, like Apple looks cheap, but like Facebook looks expensive. Like, let me buy a little bit of one and less of other. Like, they have to allocate it based on a mechanical rule. Now, of course, your decision to allocate to SPY could be because you think the securities in the 500 are undervalued or whatever, but conditional on you giving a dollar, and this is going to be important because our whole thing in this paper is about flows. Conditional on giving a dollar, they have to allocate it in a mechanical way. And going back to Ralph and Javier Gabay's work and Moto Yogo's work, like all they have this whole big thing about the inelastic markets hypothesis, right? And if you want to think about passive, they are completely inelastic. That market on close order, that's completely insensitive to prices, that is completely inelastic demand. And that's one way that it's this rule-based inelastic demand is really special in response to flows, especially.
Hmm.
Can you explain the concept of market clearing?
Right. And so this is actually something funny. So I have another project, looking at newspaper articles going back to 1900 and trying to understand what caused large moves in the stock market, going all the way back. And if you read an article from like 1925 or 1929, even is a great one. Like when the stock market's going down, the Wall Street Journal journalists, and this is remember like 100 years ago. So we're not like ragging on them. This is 100 years ago. They might say something like, well, the market went up because there were more buyers than sellers. It makes sense, right? People are buying, prices go up. But like that, it may make sense. Like it can't be, right? For every share that someone bought, someone had to sell them that share. And so
Right.
the idea of market clearing is going to be for every person who bought a share, someone had to sell it to them. For every someone who sold a share, someone had to buy it from them. That's kind of like the fundamental premise of the exercise we do in this paper.
Oh yeah, it's so interesting. So who's clearing the market when there's a demand shock from index investors?
Okay, so we have to answer this again. Maybe I'm being, a little bit pedantic, but like we have to be really careful about answering this. There's two different ways to think about clearing the market. One is going to be like a level effect, like on average, who's clearing the market, and one's going to be a slope effect, which is like when passive investors demand a little bit more, who's clearing the demand for the marginal share,
Hmm.
right? We find on an equal weighted average basis, on average, it's firms. And so what do we mean by that? Like, how does the firm clear the market? Our estimates, especially when index funds are net buyers, suggest that when index funds buy 1% of a firm's shares outstanding, firms issue roughly 98 basis points of shares outstanding. So firms, when index funds are net buyer, firms are issuing almost 1 for 1 on an equal weighted average basis. Now, I know you're thinking, Marco, wait, like something's wrong here, right? The market has to add up. We know over the last 10, 20 years, buybacks in dollar terms have been really big. We know over the last 10 to 20 years that index funds have been buying stocks. And so it literally can't be that on a value-weighted average basis, that index funds were net buyers and firms were net buyers. And that's true. However, there's two nuances there. One is we find that on a value-weighted average basis, at the margin, our estimates are pretty similar. Meaning when index funds demand more than average, firms initially buy back less and then eventually supply shares, right? But for the level effect, it's different for value weighted, right? There's been outflows out of active mutual funds. There's been outflows out of certain things like hedge funds and those things. On an average basis, yes, that's where they came from. But on the margin, we find that firms, even on a value weighted average basis, firms are still the most responsive group.
So that means when index funds have a little bit more demand, firms are issuing shares, and index funds are buying them. Firms like so that's like Apple's issuing stock, and the index fund is buying it.
So we have to be a little careful. I guess I'm being a bit imprecise here. So let's be a little more precise. That is a measure of net issuance. That includes all types of issuance, including employee compensation, the exercise of warrants, the exercise of convertible debt, SEOs, changes in buybacks. And
Hmm.
so I think that we call all that firms, but to be more precise, like some of that stuff is decisions firms made in the way past that could be happening now. So like I have a friend who works at Google, right? She gets some stock options. She was granted those on a 4-year basis, right? And so if index fund buying comes, index fund buying pushes the prices, she goes, oh, wow, this is amazing. I'm going to
Oh,
exercise
wow.
my options. I'm going to have some Google shares now. And then Google doesn't get a choice like, oh, well, we don't give you the shares. They promised in the past that they were going to give the shares, and she gets the shares. Do you see what I mean? So it's not necessarily that they're saying, oh my God, we're printing these shares so that index funds can buy them. It might be, and actually when John and I do decomposition into these different channels, we find that this like employee compensation part is the largest part. And that,
Wow.
again, like it may not necessarily be that the firm at that point is making an active decision. Other stakeholders in the firm, actually, to give you a little more of, you said, professor, that I can explain. I teach this corporate finance class. And we have this idea of the market value balance sheet, right? Rather than an accounting balance sheet, it's like the market value of the assets, the market value of the claims. You could imagine that employees who have stock options or stock grants or PSUs, RSUs, MSUs, they're actually all on the right-hand side of a market value balance sheet in the sense that they do have a claim on the cash flows of the firm. However, that claim only materializes when stock prices are high, right? When their options are in the money, when they get
Hmm.
granted the stock. And so they go from being on the market value balance sheet to the accounting balance sheet. And that also, if you look at that kind of figure 2 in our paper, we have this really cool kind of, and I wish I could pull up a graphic right now, this really cool kinked shape where we show that basically when index funds are net buyers, firms respond a lot. When index funds are sellers, they don't. And if you think about, again, our mechanism of employee compensation, right? Employees, if index funds buy a lot and push up prices, employees can exercise their right to get shares. If index funds sell a lot and prices go down, employees can't force their employer to buy back shares, right? They have a one-sided compensation contract, and that may explain that super option-like feature we observe in figure 2 of the paper.
So interesting.
So on causality though, like how do we know the direction? So like index funds would need, in your example with your friend, she exercised her stock options. Index funds need to increase their holdings in response to issuance, right?
Right. Okay. So yes, let's go through. I think that, just to explain a little bit more. So there's two things here, or at least two things here. One is a reverse causality story, which I think is what you're getting at, right? So the idea is if a firm does, say, an SEO, right? So it says a seasoned equity offering, and they sell 20% of shares outstanding. I'm picking a big number, but let's pick a big number to make it easy. Now, suppose previously index funds held 10% of that firm's shares outstanding. Let's suppose also there's no float adjustments to make it easy, right? They're going to have to buy 10% of that issuance, right, to maintain their 10% ownership of the float adjusted cap of the firm, right? So you're saying, well, Marco, what you're actually getting is a firm issues a lot of shares. Index funds need to, in response to issuance, buy shares. And so you're going to get a reverse causality where it's actually the issuance that causes the buying, not the other way around. That's one problem for us identification-wise. Second problem for us identification-wise is going to be an omitted variable story. So the idea is, suppose that we think about a company like, there's some new technology shock. Suppose that now generative AI is getting commercialized. Everyone loves generative AI. Well, all the firms that are exposed to generative AI that can leverage that are going to say, issue equity to buy, GPUs. They're going to pay equity to their employees to get new people to work there. And at the same time, people like you and me who want to be in on it might buy ETFs that are exposed to it, say, right? And then we'll have at the same time, the firm will be issuing, ETFs are buying, but it's really because of a common omitted variable. And so we're going to try to attack the reverse causality and the omitted variable problem at the same time with an instrumental variable strategy. So what are we going to do? The first thing is we're going to focus on flows, like I highlighted before. Why flows? Because the flows part is not necessarily going to be subject to this specific reverse causality you talked about, right? And the second piece is we need to identify shocks to passive demand that come from flows that are not related to fundamentals. And so this AI revolution is like a fundamental shock. It's about how you were doing as a firm or how you're expected to do as a firm. And so I don't know how much detail I should go into, but I'm going to try to explain, kind of distill down the idea. So the intuition of this instrument we have, which is going to be basically, we're going to try to predict changes in passive demand that are uncorrelated to your own fundamentals and that come from flows. And so the way we do that is we actually leverage something interesting that we notice, which is that there's a strong flow performance relationship in passive funds. First of all, at some level, this is weird, right? Like, when you think about, oh, this active manager is doing really well, I'm going to give them money because I think they're skilled. Like when the Russell 1000 does well relative to the 2000, it's not because like IWB was, better at stock picking. It was because those stocks happened to do better. It's not like if you're giving them money, you're getting access to their skill.
Yep.
But that's true in the data. And it's actually, there's a lot of heterogeneity across funds, but that's true in the data. And then what we exploit is, look, like, well, maybe, my company is in the cows 100. Your company is in the cows 100. The cows 100 actually is pretty sensitive for performance. And you and I are unrelated. So we are going to look at basically the co-holdings that are not in the same industry, not in the same momentum, value, size, kind of like factor exposure buckets. And, all these unrelated stocks do well. This leads to flows into your fund, which leads them to buy you passively, right? And we're going to do an instrumentals variable where we're going to instrument for observed passive demand with this exogenous part of passive demand. And we're actually going to find almost identical results. So we're going to find that even in this IV setting where we've really narrowed the scope of the flows we're looking at, our point estimates are nearly the same.
How important has firm issuance been to the growth of assets managed by index funds?
So again, we need to be a bit careful about equal weighted versus value weighted, right? So, what's something interesting we found out, net issuance, meaning just change in shares outstanding. On an equal weighted basis, 80% of firms in a given year over the past 20, 30 years have done net issuance, equal weighted average basis. On a dollar weighted average basis, it's net buybacks. And so we have to, we could say that, look, John and I's estimates suggest that, overall, for every 1 percentage point of a firm bought by passive index funds and ETFs, this is marginal, firms issue, say, 65 basis points. And that comes down to about 35 basis points from employee comp, warrants, like 25 basis points from SEOs, but that's kind of misleading because those are really lumpy. The average SEO is like 10, 15% of shares outstanding. And then the rest is coming from adjustments and buybacks. So we have to be careful about that. The second thing we have to be careful about is that even though about 20% of firms have buyback programs, if we narrow in on those firms' buyback programs are much more responsive to passive demand than firms that did not, say, in the past year or 2 years have a buyback program at all. And so we just to say how much actually came from issuance, like it's really tough to exactly nail it down. And also there's like a counterfactual, like, well, if firms weren't issuing and passive demand was coming in, prices might have adjusted up a lot more, right? Which would have changed the incentives. And so I don't think that John and I really have like the exact counterfactual for all those reasons to answer that question, but those are at least the factors you might need to think about if you were trying to answer that question.
Amazing.
You threw out a bunch of numbers just now. Can you say where are the shares provided by firms to meet passive demand actually coming from?
Right. So we do this decomposition exercise, and I'll just kind of break it down a little bit slower. So like that main figure 1 and figure 2 in the paper, we're looking at an overall measure of issuance that includes all changes in shares outstanding. Now, the ways that a lot of people think about it is this comes from buybacks, where the firm literally is going out and buying shares, adjusting the supply. We hand collect data from Bloomberg on seasoned equity offerings. This is, what's actually really interesting if you think about this, Tesla sold shares directly to the market before being added to the 500, right? That's kind of a very clear example of the firm accommodating passive demand. Facebook did a traditional SEO, I think just a day before or a few days before being added to the 500, right? So we're going to hand collect data on all those shares being sold by the firm to the market. That's a second source. Then we have this residual category. Now, it turns out that as far as I understand, you do not have to report to the SEC how at least in the 10Ks, how every possible change in shares came about. Now, some people do. So NVIDIA, if you look at their 10K, they'll have like, okay, we have this many restricted stock units, this many preferred stock units, this many, employee options, this many were exercised. And so John and I are in the process of scraping all that data. And for a subset of firms, we do have the option-based comp, share-based comp, and we can kind of do an even finer decomposition. But for now, let's lump together all of that kind of forms of issuance that come through basically employee comp, PSUs, RSUs, MSUs, options, and then warrants and convertible debt. And so, if you think about, like, for example, a company like Carnival during COVID issued a lot of convertible debt. Their stock price recovered after COVID, and they ended up having to issue a significant amount of equity. However, not everyone does. And so this is another tricky thing that John and I are working on, is that you might hedge that. You might have an investment bank on your behalf provide the shares to the people who you promised the shares to with the convertible debt, and then that doesn't lead to issuance. And so you can't just like go in and like use convertible debt right away because that might be hedged. So for now, we have a very simple other group that captures all these different features. And so, among our baseline total effect, a little more than half is going to come from this employee comp, warrants, convertible debt. About a third is going to come from SEOs. But again, we have to be careful with that because that's very tail heavy. SEOs are kind of rare, but when they happen, they're big. So, that's that. And that also might be more subject to the reverse causality, at least if we're running an OLS regression. The reverse causality problem there is probably larger. And then the rest is buybacks.
So does this imply that compensation of skilled labor income is tied to index funds buying up shares in companies?
Right. So this is a really good question. And I think when I first started thinking about this, and I've talked to people about the project, it's like, if you're a VC investor and you invest in a company, like when the company goes public, maybe that's your opportunity to exit. And maybe there's this other weird thing going on that one employee's option to exit is that they effectively, of course, some intermediation has to happen. Like when my friend works at Google, gets her shares, she doesn't call up Vanguard and go okay, guys, here are the shares, I'm sending them to you. Some intermediation might happen there, right? But you could say that her skilled labor is being bought out by Vanguard or whoever else. I think that's
right.
One thing, but I think that we have to zoom out and think about more broadly, how important is this relative to other factors? So NVIDIA is a great example, right? NVIDIA's stock went up a ton. And I heard this story kind of casually that so NVIDIA, as far as I understand, you can exercise your stock options anytime within 2 years of them being granted. And so the price went up a ton and a bunch of people who had worked there for a while had these options, they exercised them. And then house prices in San Jose went up a lot because these people who were suddenly much wealthier than they were before were able to afford much nicer houses in San Jose.
Right.
And so when we go to your question of, how does this link to the compensation of skilled labor income? We have to think about how variation in prices is due to how much of variation in prices and specifically positive or outperformance is due to index fund buying versus say fundamental outperformance. NVIDIA didn't go up as much as it did because it got bought by index funds. NVIDIA had a product that a lot of people wanted and would be really, really useful.
Yeah.
And so while to some degree, yes, maybe index funds might push up prices around a little bit, but I think that at the end of the day, fundamentals are likely much bigger driver of prices than index fund demand, at least casually. I don't have a quantitative estimate of that, but that's my intuition.
Yeah, that's an interesting answer. Well, can you talk about the conditions that affect the responsiveness of firms in accommodating the passive demand?
Right. So if we think about the most basic advice you could give my MBA students is you want to buy low, you want to sell high, right? And so you could imagine that firms, and Jeremy Stein had this 1989 paper in the QJE, and it kind of hints at this idea that firms ultimately are the arbitrageurs in their own shares, right? Who knows better how much a firm is worth than the firm itself? But firms obviously don't have unlimited flexibility in doing this, right? They can't go out and just buy whenever they want. They can't, for example, buy a certain part of the day. Buybacks can't happen at certain times. There's a lot of rules, but firms could be the ultimate arbitrageurs in their own shares. So John and I say, well, if we think about this simple advice, when would you want to sell shares in the face of passive buying? Well, you would want to sell shares when your shares look relatively expensive. And so in the paper, we look at kind of two very simple measures of expensiveness, excess earnings yield and book to market. And we find that it looks like firms are much, much more likely to accommodate passive demand when their shares look expensive, when they look like a growthy firm, when their excess earnings yield is low.
So who clears the market under conditions when firms are less likely to respond to prices?
So this is something I know you guys had Mike Green on the podcast before. Mike and I actually talked about this. When I was working on this paper, early on in the paper, I sent it to Mike, and he noticed right away that, I told you we have this kind of hockey stick picture, which says that when index funds are buying, firms are issuing, but when index funds are selling, firms are not buying back. And so that means that when index funds are selling, someone else has to clear the market. Now, we in our data set, try to do as very careful accounting exercise as we can for a bunch of different groups of investors. So we look at, active funds, passive funds, foreign funds, pension funds, insurance companies. We have all these different individual investor groups. However, because of market clearing, for every buyer, there has to be a seller. And there's some groups we can't see, like foreign institutional investors, retail investors, institutions smaller than 100 million. And we find that in the case of aggregate index fund selling, it's this other category made up of retail investors, foreign institutions, and small institutions that tends to clear the market. Now, John and I's thinking about this is that, well, given that on average index funds have been buying a lot over the past 20, 30 years over our sample, maybe stuff that has really big index fund selling is stuff that's leaving the investable universe, right? For example, like maybe you do a tax inversion and you become a Canadian firm, right? Index funds sell, but then maybe many US institutions have mandates against holding those stocks. We're going to need someone else to clear the market. But when I showed this to Mike, he was like, oh man, like this is kind of scary, right? All the people who you think might be clearing the market when index funds are selling or not, we need this other group. And that was something that I think is kind of something in the paper we don't push too hard, but we've been trying to amp up a little more, is we need a different group to clear the market when there's big index funds selling.
Wait, so do we know who's clearing the market?
We know that it is, do you know what dead reckoning is?
No.
Dead reckoning, as far as I understand, is a type of navigation system for like missiles. And like there's like this joke that a missile knows where it is by knowing where it isn't. And it knows where it isn't by knowing where it is. It's basically like a relative positioning system. And so I guess what we know is that we know that we don't have market clearing coming from above the institutional groups and mutual fund groups and insiders and short sellers that John and I can track down.
But it's coming from somewhere.
Yeah, and that's why I said most likely we think it's small institutions, foreign institutions, or retail investors. These are the groups that John and I cannot track. And so mechanically, it has to be among these groups, but we can't say, oh, it's retail, oh, it's foreign institutions, because we literally, for many of these groups, cannot track their holdings.
Okay. So, I mean, you brought up Mike Green. How do you think the market would respond to significant net selling by index funds?
Well, I guess what I would ask Mike is that how is that different than significant net selling by, say, active funds? Like there's this very famous paper in the Journal of Finance 2007 by Koval and Stafford that shows that like there was something that happened. It's called fire sales in mutual funds. Basically, because of something that happened, a bunch of active mutual funds had to sell a bunch of shares and prices went down. And so the first thing I would say is that like, is there something special about index funds selling a lot of stocks versus say like when CalPERS reduced their allocation to equities from like 60% to 40%? Like, is there something different than that? I don't know. That's the first thing. And then the second thing I'd say is that, yeah, I would say that, if you take our estimates seriously and you take our paper seriously, it would need to be that other groups step up. Now, something I didn't highlight is that when stocks, everything we've been talking about so far is really focused on results due to flows. Now, in 2% of firms' quarters, we have stocks that are out of their drop from indices. So you might, if you're, for example, dropped from the S&P 1500 universe, have massive index fund selling, right? We find that in these cases, hedge funds and financial institutions actually do step up a lot. Active funds do step up a lot. So then the second question is, okay, suppose we believe passive selling is special. What is the reason for the passive selling? If it's an anticipated passive selling due to indexing rebalancing, like we talked about, these salient events that people prepare for months, then I'm not that worried, right? We know in the data that these other groups, I guess the thing that I don't quite have that you might imagine might have a relatively larger price impact is if we had a very large flow-driven shock to passive selling, then it might be that has a significant price impact because a lot of people who tend to trade the same way as passive might also be selling, amplify that demand shock. That might be, have a larger effect on markets.
But it's kind of a lot of things would have to happen at the same time.
Yeah, it would have to be like, the flow, it's flow driven. It's like it's a lot, like it's large. Cause like also like, remember that hockey stick for small passive selling, we have these really cool bin scatters in the paper in the appendix. The financial institutions group actually kind of has a little U shape. And for small passive selling, financial institutions, which includes hedge funds, do accommodate the market a little bit. But once passive starts selling a lot, they don't necessarily for flow-based passive selling. So again, like it would have to be significant flow in the same direction. Financial institutions don't have the capital. Like it'd have to be like a perfect storm of a lot of stuff. And then maybe that could be, not great for security prices.
But also, like you said, that's not necessarily unique to index funds, right?
Yeah, exactly. If everyone decided, if CalPERS and everyone else decided to reduce their equity allocation by 20%, I think prices would probably go down.
Right.